You can't go to a money market and expect it to work as well as a supermarket does. We covered that. So, what do banks do and financial intermediaries in general to handle all these problems on this page? And most importantly and most excitingly, what is the jargon we use to describe it all? Well, transaction costs. That is the jargon we use to describe the problem that comes from. Well, the big part of this is you have one person saying, yeah, I'll give you 200 grand to buy a house and I'll charge you this interest rate. Well, how do you know if anything is better out there? How how do you know if there's someone who has fewer fees or something like that? It's difficult to know if we're just living in a world without financial intermediaries and people just walking around. Hey, can you loan me 200,000 bucks? No? Okay. Have a nice day. Hey, you stranger, got 200 grand? I'll pay you interest over the course of 30 years if you lend it out to me, just so I can buy a house. That's all. No? Okay. Somebody finally offers you that loan. How do you know who they are? That's a transaction cost. It's costly to do the things you need to do to make that transaction work. Information costs, it sounds like very much the same thing, but that goes on the side of people looking to lend money. Hey, I got a ton of extra cash laying around. I've done a great job saving my money, or I've run a successful business, or I make a lot of money at my job, and I have all this extra money. I don't want inflation to eat away at it. Where can I put it in order to get a good rate of return? Let's see. Hey, you want me to lend you some money? You pay me back some interest? No? Okay. Oh, you want some? Talking to some other person? Well, okay, great, but how do I know you're actually going to pay it back? Those are the information costs that financial intermediaries deal with. And then, of course, there's the overall risk of, okay, I've ascertained that you're a credit-worthy borrower, and the borrower says, okay, I've ascertained that you're a responsible lender, and that this is a good deal that I'm getting. So now the only question is for the lender, how do I know that I'm not going to go out of business if some unforeseen future event happens? That's just the general risk involved here that financial intermediaries exist to address. So we have transaction costs, information costs, and risk. So financial intermediaries. Before we get into banks in particular, which is going to be our focus, we're not going to talk too much about the other kinds, but it is there are other kinds, and this is as good a place as any to introduce some of the jargon. So we separate financial intermediaries typically into two categories: depository institutions and non-depository institutions. And that those are descriptive terms. A depository institution is an institution into which you make deposits, and you can make withdrawals at any time. A non-depository institution, money goes into them, but you can't just withdraw it at will, typically. So depository institutions, again, that's going to be what we're going to focus on. Banks or credit unions, which are essentially, they're like banks. We, again, don't go into too much detail as to the differences. There really aren't very many differences. It's basically the ownership structure is the major difference. But uh, they actually function very much the same way. And sometimes some of the things that credit unions ought to do better, banks do better, and then sometimes credit unions do other things better. But that's a whole nother topic, which is kind of interesting, and economists still look at differences between them to see if there really are significant differences in the model. And while some economists say yes, there are, others aren't so sure that there are any real differences that aren't the same as the differences between big national and international banks versus small local community banks, and there's some drawbacks there too. Anyway, it's a bit of a diversion. We're going to focus mainly on the banking system, but non-depository institutions, we've actually already talked about them, at least in passing before. Mutual funds, you put your money in a mutual fund for much the same reason you do a bank, at least when it comes to long-term savings accounts. So why isn't it a depository institution? Well, because the bank expects that people are going to come and get their money out right away. And you put it in with the understanding that you're putting it there for now, but if you need it back, you can go and get it back. With mutual funds, it doesn't work that way. You're generally putting money there that you expect you're going to keep there for years and years and years, and they expect you're going to keep it there for years and years and years. They do not promise to give you back any of your money instantly when you call upon them to do so. Instead, they promise to give you back your money if you give them a period of oftentimes as much as a couple weeks or more to sell off some assets first. So they don't, in other words, they don't leave cash lying around just in case any of their customers want to pull anything out. If you wanted to take your money out, you have to plan on that. You have to know you're going to do it and tell them on this date, I would like some of my holdings back. So they don't promise to give your money back at will like banks. Demand deposit means that as soon as you demand your money back, you get it back. Now, some mutual funds do have accounts from which you can make withdrawals, almost like an account where you're borrowing from your own fund. But that's a bit of a complication that it doesn't apply to everybody, and it still doesn't exactly work like the banking system. So mutual funds are non-depository institutions. And remember, mutual fund is a company that will put your money into stocks, mainly stocks, but also bonds and commodities of other kinds. Investments, places to put your money where it's going to get you a decent long-term rate of return. And they take their financial intermediary because you could go straight to a company and try to buy its stock. You could go straight to somebody who owns a barrel of oil and try to buy it from them. But it's pretty tough to know where to go to find these individuals and how to negotiate with them and so on. Mutual funds specialize in that sort of thing. So you give them money, they go and do it for you, they keep a small fee, and you get the majority of the interest. So what are insurance companies doing here? They don't seem like financial institutions at first blush. Instead, they're companies that protect you from events that hopefully don't happen. A car insurance company is going to pay to fix your car if you get in an accident, provided that it's covered. You send money to the insurance company, and you hope that you never need them to come in and help you out. You hope your house never burns down, but you have fire insurance on it. One way that insurance is described, that is an apt description, is that you're making a bet against yourself and hoping that you lose that bet. The bet against yourself means you give money to the insurance company, you're essentially betting that money on something bad happening to you and you needing that insurance company to swoop in and help you out. But insurance companies don't just take money and then give it to people when claims are covered. Again, remember, you hang on to cash, it's going to lose value. So what insurance companies do is what mutual funds do, actually. They put that money in some sort of investment. A lot of insurance companies will only put that money into bonds, but some do put money into diversified portfolios that include things like stock. And the interest, in addition to premiums paid by people who never needed anything covered, are where they get the money to pay for whatever covered claims they have to pay out. So they are intermediaries in a slightly different way, but here, where mutual funds are helping you invest money in the specific things you want to invest it in, and banks are just parking your money for you until you need it back, insurance companies are actually selling you some protection for the money you're giving them, and then they are going and investing it in ways that you usually don't even know they're investing it in order to make their business run a little bit better, be more profitable and more sustainable so that they can stick around and cover your claims when you need coverage. But they're non-depository institutions because, again, you get cash value on certain life insurance policies. You can make withdrawals from that cash value and never need to pay it back necessarily. That's a bit of a complication and an exception to the rule. By and large, insurance companies, you're not depositing money to be able to get it back. You're giving them money and hoping you never need it back, essentially. Unless you're planning on executing insurance fraud, but let's not any of us go and do anything like that. So, back to depository institutions. What financial intermediaries do, they specialize in a lot of different things that allow them to handle these issues that will cause money market transactions not take place. So let's take them one at a time. Transaction costs. Recall that this is the problem of not really knowing if you're getting the best deal, not knowing what else is out there. It's that antithetical situation to what we talk about in microclasses with perfect competition, where everybody knows who your competitors are, what they're selling, and the prices at which they're selling it, and they can go there easily and get the same thing for a better price if you don't match their price. That's perfect competition. That doesn't really exist in financial markets, and there, for a lot of reasons, we can expect that it never will exist. So the solution to this problem is product standardization. Product standardization basically means that different lenders, if you're going to get a mortgage, you can get little details of the mortgage that are maybe a little bit different, but for the most part, they're all the same. You get money, you pay back interest as you pay back the principal, you can pay it off sooner. Some lenders will charge fees, others won't, but oftentimes the only difference that really exists is the interest rate. A lot of the terms of the loan are very much the same from one lender to the next. So it's easier to, you can still shop around and banks will still try to compete for your business, but it's much simpler and it's much easier to do. There isn't as wide a variety of products. So what can be a very complicated thing in a money market left to its own devices becomes a little bit simpler thanks to banks being able to standardize products by meeting with a lot of lenders and over time knowing what general situations, meeting with a lot of borrowers and knowing what kinds of things borrowers want the most so they can put together a product that's most competitive. Information costs, this is credit monitoring. We don't know if you're going to pay the loan back, if you're the type of person who will pay the loan back, but we have credit monitoring organizations that can put a number on your credit score that tell us if you have a history of taking out loans and paying them back. You have a history of taking out auto loans and making your payments, of charging credit cards but paying your credit card bill, of taking out a student loan and paying that back. And heck, we see a couple mortgages you've taken out and you've paid those back too. You're a pretty credit-worthy person. And then there's also the fact that banks become very good at knowing how to quantify people who are higher risk or lower risk. How much cash do you have on hand? Do you have a savings account with a lot of money in it? Do you have retirement savings? Do you have life insurance so that whoever is going to be on the hook to pay your mortgage when you die, they're going to have the money to do it? Some banks will actually require that some people take out a life insurance policy to cover the loan in case something like that happens. What kind of job do you have? Is it a type of job that tends to be secure? What is your income? Do you have other sources of income? Do you have other liabilities, other debts? A whole bunch of questions that you're going to have to go through when you get your mortgage, buy your home, if you ever do. Banks become really good at knowing what questions to ask and whether to approve or not approve, whether to charge a certain interest rate or not charge a certain interest rate, etc., on the basis of the answers to these questions. Financial intermediaries who are professionals at screening potential borrowers to make sure that savers, who are ultimately the lenders, people who put their money in the bank, are going to be able to lend their money to people who are likely to pay it back. Finally, risks. The risk of real life happening. You have a job you think you'll never lose, and then you lose it. That risk is mitigated by pooling and diversification. So diversification basically means you have a lot of different types of places your money's going. You're giving a lot of money to people who are taking out mortgages, but you're also giving money to businesses. And then pooling means you have a lot of these risky scenarios, a ton of them. So the more you have in that pool, as long as you screened them correctly and charge the right interest rates, the more you're covered for any one of these scenarios where someone can't pay their loan back for whatever reason. The vast majority of your loans are being paid back just fine. So any losses you take on this default is going to be made up by all the rest of the loans you've given out. So a little more detail on banks in general are coming, but that's for the next video.